We saw that when we were making our business transactions, we were putting them into what it looked like a spreadsheet with different columns. We were just adding all of our business transactions into that spreadsheet. As you see, it kind of got a little busy, and it can get a little busy. That's why it's not very practical for a company to use that spreadsheet to post journal entries, post our journal entries. And that's what it's called when we put those business transactions into our accounting system. We are making journal entries. And what we'll do is we will post those journal entries directly into an accounting software, and we wouldn't use that spreadsheet. In this class, I'm going to show you all how to use T accounts to post journal entries, which is an easier way for us to be able to track the different account balances in separate accounts. Okay. So in class, we will use the shortcut called T accounts, and this is what a T account looks like. So at the top of the T account, we will have the account name, like we would have cash if we were working with the account cash. And then we have a debit side and we have a credit side. So or debit and credit means. So whatever you think debit and credit means, I just want you to go ahead, take that out of your brain, toss it in the trash for this class. The sooner you unlearn what you think debit and credit is, the sooner you will be able to understand accounting, okay? So what do the word debit mean? The new definition of debit in this class is left. So what do debit mean? Left. And what do credit mean? Right. So debit means left, credit means right in accounting, okay? Debit means left, credit means right. And sometimes we abbreviate debit and credit as DR and CR. So DR stands for debit and CR stands for credit. The account again, as you all see, we have our debit on the left and our credit on the right. So keep that in mind. Debit, left side, credit, right side, okay? So our T account can be used to track the balances of accounts. The debits are shown on the left side, and then the credits are shown on the right side. The excess of the debits over the credit or vice versa is the balance of that account. So typical T accounts. So for that spreadsheet that we worked on in the last video, if we were using T accounts, it would look something like this, but we would have those balances in there. Let's talk a little bit more about a T account. So here we have the cash T account, and we have all of these different transactions. So where you see A, B, D, E, F, H, these are all business transactions that has been posted to this T account. So anything that's on this debit side of this particular T account, this T account for cash, this was an increase in cash. And this was a decrease in cash. Anything that's on the credit side was a decrease in cash, okay? So then as you see, after we add up all of our debits and all of our credits, we have a balance of 5,900. So that's what we would call the balance of the account, okay? Account, we increased on the debit side and decreased on the credit side. All of our accounts are not like that. That's why it's important for you to learn the normal balance of accounts